Hey everyone, Michael here. So in this video, I want to walk you through the future growth section of the company report. And I'll go into specifics on the metrics we check, why we check them, and also how to interpret some of the charts and visuals that we show in this section. So before we get to that though, why is it so important to assess future growth? Well, ultimately, future expectations are like the bedrock of any valuation you see. So whether it be the stock price that a business is currently trading at, or someone's valuation of that they've got from like a model, both of those are based on their expectations of what they think will happen in the future. So it's very important to consider because future expectations give context to what a company is trading at today. So, for example, if you were to see a stock with like a PE of 60 and that's all you looked at, you might think, oh, that's expensive. A PE of 60 is very high. But without looking at the future expectations, you really have no context as to whether that's expensive or not. So, for example, that same company could have expected earnings growth of like 50% per year for the next 5 years, which is huge. And if that's the case, then all of a sudden that 60 PE seems very cheap. And alternatively, like on the other side, if that same stock with the 60 PE had earnings growth expectations of like 2% per year for the next 5 years, then yeah, that 60p seems very expensive because it's not very high earnings growth to back up the high PE. So yeah, without looking at future growth in alignment with valuation, you just really don't have any context. So that's why you've got to look at both of them together, and it's also why it's the second part of our company report. So now on to the metric checks. They're just a bit further down here, and I'll start from the top. So you can see this first one we have here is earnings versus savings rate. Now, why do we check this? Well, basically, this is just a bare minimum, right? So, like the alternative you have, or investing is pretty much a game of opportunity costs. You have a whole bunch of opportunities in terms of investments in front of you, and you have to pick one or some. And this purpose here is basically to compare it to a low risk government bond because typically, like interest rates change all the time, but typically at the moment you could get around 2% for a low risk government bond. So if that was the case, why would you invest in a company if it didn't earn any more than that? Because a company or a stock is considered riskier. So we check this as just a bare minimum to see that it's got at least some growth. And in this case, the company has 10.6% per year earnings growth expectations. So it passes that test with flying colours. The next test we do, or metric we check, is the earnings rate versus the market. And the reason we do this is for basically to get like a comparison as to how the company performs versus what else is out there. And this is important because, like I said, it's an opportunity cost. Is this company that you're looking at the best opportunity? And in this case, the company doesn't pass that check. So if you're looking for companies with high earnings growth and you're looking at this company here with 10.6%, and the US market, which is made up of all these different companies, shows you that the average expectation of earnings growth is like 14% per year, well, then that tells you that all of a sudden there might be better opportunities out there, like companies that have higher growth expectations. So straight away that tells us that, okay, it's not exactly a high growth company, it's pretty mature, like there's newer, younger, more high growth companies out there. So that's why we do that check, and we can see here that this is a mature business. The next check we do isn't a relative check like that one, it's an absolute check. So we don't compare it to anything else bar a hurdle rate of 20% per year. So the reason we do that is because if both of these earnings were above 20%, like the market and the company, then this test here is just to say that, like, yes, it may underperform the market, say if the market was 25 and the company was 22 or something. This check here is just to say that even though it underperforms the market, anything above 20% is still great. So that there would be ticked if it was a high growth company. But as we saw, it's not a high growth company. In this case, it's only roughly 10% per year, which is a pretty average growth rate. So now the next thing we look at is revenue versus market. Same exact concept, except it's basically obviously for revenue. So while earnings are obviously the most important part, revenues can be very indicative as well. And so in this case, the company actually performs better than the market. So if you were looking for high revenue growth, then this company is above average, right? Like the average revenue growth expectations is 10% for the market, whereas here it's 12.3 for the company. So the company is better than average. So it passes that check. And that's on a relative basis. And then when we do the absolute basis, which is the next check here, just like we did for high growth earnings, this high growth revenue, it doesn't pass the check. So this tells us that it's, again, not a young business, it's pretty mature, it's well established, it's growing, but it's not growing too fast. So it's got like an average growth rate. So just from those 5 checks there, we can already tell that like it's got some growth potential, but there's probably some better opportunities out there if you're looking for high growth. And the very last check we do, because that's 5, the very last check we do is future return on equity. So basically, return on equity is a measure of how profitably management allocates shareholders' equity or money. And there's a measurement of this in past performance, so you can see how well they're currently doing it. And the future return on equity is basically any analysts who have submitted their expectations for how well they think the company is going to continue to do the same in 3 years' time. And in this case, when we look at the business, it's an incredibly profitable business. So anything above 20% is considered good. And in this case, the business has a return on equity, or is expected to have a return on equity of about 38% in 3 years' time, which is very high. And when you look at that compared to the industry, which is only expected to be about 11.4%, that just tells you that this is an incredibly profitable business in the software industry, and it outperforms its peers in terms of its ability to generate profits well. And that's because what we can infer from that is like it obviously has really promising projects that it can invest in that generate a big return on their investment. And so, yeah, it's at a stage where it's very mature, it's more than breaking even, and these investments are generating a really high return on that equity. So in this case, very good to see that in 3 years' time, the company is expected to still have profitable initiatives to invest in that generate a really high return. Now, if we go back to the top of the chart, the top of the future section, what we can see here is the a combination of all the analysts that cover the stock. So in this case, there's 38 of them, and we can basically see all of the expectations that they have provided for their estimates of what they think these metrics will be in the future. So this chart here, anything to the left is the past, like it has happened, anything to the right is their future expectations, like when they've submitted their estimates. And now it's important to note that these are the average. So some analysts have higher expectations, some have lower, but these lines you see here are the average. And also worth keeping in mind is that these estimates keep changing. So as businesses grow and develop and keep updating and progressing, analysts will change their expectations, right? Because they all have their own models. They're all trying to model what they think will happen in the future. And as like a new product gets released, or a surprise acquisition announcement, or cost cutting, or whatever occurs, these analysts will go back and change their models. And so this chart here changes as their estimates change as well. So this is the kind of chart that you wouldn't want to check like once a quarter. Some analysts change their estimates relatively regularly. Usually they do it around reporting season, so it's probably like once a quarter. But this isn't something you want to just check for 1 year and leave. Like if there's plenty of analysts covering it, they typically update their models pretty regularly at different intervals too. So it's worth keeping in mind that this does keep changing, and also the valuation section, which is also based off future expectations, will therefore update as well. So as analyst estimates and expectations change, this future section will change, and the valuation section will change. Another thing to note is that if we have a company that doesn't have any analysts covering it, what we'll do here is, because there's no estimates provided, we'll next check if there's a long enough period of past performance to try and decipher if there's a trend going on. And if there is a long enough period of past performance going on, what we'll do is we'll basically decipher what the trend is and then extrapolate that trend into the future. And now obviously that's not like anyone providing those estimates, it's just us basically giving an indication of if this were to continue, here's what it could, if this trend was to continue, here's what it could look like. So just keep that in mind when you're looking at a company with no coverage. And lastly, if there is no like long enough past period of performance, that's a very small percentage of companies, there won't be any chart here, just something to keep in mind. And so when you're looking at this chart, what you kind of want to look for is basically trends. So is there a very easy to decipher sort of trend occurring that you then believe will happen in the future based on what you know of the underlying business, like new products entering new markets, new services they're releasing, stuff like that? Is there a trend occurring, and is it likely to continue? Now, in this case, we can see that analysts who really know the underlying business well believe that this trend is likely to continue. Now, when I'm looking at this, what I would do next is go and do my own qualitative research, because this is quantitative research, like looking at the numbers. Qualitative would be like I go and check out what the business is doing, like I mentioned, new products, services, markets, stuff like that. So then I can get my own color and context on these lines here, and these expectations, I suppose, and then basically understand that, like, yes, I do believe this is likely to happen. One thing that's important to note is like, you may have different expectations, and we'll get down to that in the earnings per share expectations. So next thing here we have is the chart, and this pretty much is a visual representation of the checks that we saw below. And the key thing to look for here is that it also includes industry. And so when you're looking at this, it's important because obviously the checks are versus the market to show you basically the opportunity cost and if there is better opportunities out there. But also we display here the industry, and this is important because it's the same purpose, right? To show you if there's potentially better opportunities within that industry you're looking at. And in this case, looks like there is, right? So if you want a high growth company, it wouldn't be this one that you're looking at. It would actually be, there looks like there is actually plenty of players in the software industry that are expected to have higher earnings growth. So my takeaway from that is I look at this and I go, well, I do want high earnings growth, so I'm going to go have a look at either the US market and filter for anything above, this 11%, so I can see companies that have higher earnings growth than this company, or I can go to the software industry specifically and see what I can find there. And the same sort of thing for the revenue as well. So this is a mature business, and there's younger, more high growth companies out there in both the industry and the market. So the next chart we have is the earnings per share growth forecast. Now, just a quick summary is this thick blue line here is the previous performance, and this is GAAP earnings per share, by the way, generally accepted accounting principles. And this thick blue line here is the previously reported earnings per share from the company. And the blue shaded area is analyst estimates, like their range of estimates for those periods. So straight away, the takeaway here looks like that the company has outperformed analyst estimates for the last couple of periods, which is a pretty interesting takeaway, meaning that the company has performed so well it's even outdone analyst estimates. So that's interesting. And then this teal blue line here is the estimates going forward. And the teal shaded area is the range of estimates. So I can see here the most optimistic estimate and the least optimistic estimate, and this blue line here is the average. And so what's important to note here is that this obviously there's a whole bunch of analysts in between here. Like we can see 14 analysts are provided for this sort of period to 30 June 2024. What's important here is to then go and do qualitative research, right? So this gives you an indication of, okay, generally analysts expect the company to grow in the future. Some expect it to grow really well. Some expect it to have a much lower growth rate. But overall, they expect it to grow pretty well in terms of its earnings per share. Now, what I would do next is I'd go and do qualitative research where, like I said, I go look at the underlying business, I go look at its fundamentals, and I see what products they're releasing, markets they're entering, stuff like that could support these. And then next, I have to make a decision, like a judgment, of which ones I think are more likely, right? So as I continue to research the stock and I get a better narrative and understanding around it, I may then look at all the projects that they've got going and what's likely to happen in the future. And I may look at this most optimistic estimate and think, yes, I do agree with that. I think that's likely to happen based on what I've looked at. So then all of a sudden, if that is likely to happen, then I might think that today's current share price is undervalued, right? Like I might think it's actually a bargain because everyone's expecting it, or the average is expecting this sort of earnings per share, but I actually think it's going to be higher. So that might tell me that I think it's undervalued at today's price. Alternatively, if I look at those same underlying things they're working on, and I look at I look at those same underlying things and I think, no, they're probably not going to have as much growth as everyone thinks they're going to have, and I think it's actually like a pretty sort of poor investment or poor initiatives that they're working on. I don't think it's going to have that much growth. I think earnings per share might be here in the future. Then all of a sudden today's share price where it's trading I might think is very overvalued because I think it's not going to have as much growth as everyone else thinks. So that's something important to take away when you're looking at this earnings per share growth forecast. Again, it's GAAP earnings per share. But yeah, so to provide more color and context to this, it's very useful to go and do the qualitative data on where these people are getting these numbers from, like what the business is working on that could help them grow. And yes, of course, last we have the future return on equity chart that we covered before. And yeah, so that's the future section. And now the next steps would be basically, if you finish looking at this company, which as we looked at, it has some good growth potential, but it's not the best growth potential, right? That's the takeaway from finishing that because it passed 3 out of the 6 metrics that we check. The next steps would be, okay, well, do I want a better growth performer, like a company that performs better in terms of its future expectations? So if that's the case, what I can do here is I can go and explore growth companies in the software industry. And now this page here shows me US software high growth potential companies. And it's another way of looking at companies that have better future expectations than that one I was just looking at. So I can scroll through here and look at all these details here, and then go further again on these individual companies, and then assess their futures, how they perform in the future part of the report as well. So yeah, that's pretty much a run through of the future growth section. Hope that was helpful, and thank you so much for watching. See you later.